Okay, let's just dive right into a fundamental truth that completely reshapes how we need to view the stock market. Dividends are not free money. I know they seem incredibly simple on the surface, right? But actually, they are this profound mirror reflecting whether a company is truly generating cold, hard cash or if they're just playing accounting games with your money. So in this explainer, we're going to look right past those attractive yields and use some real CFA-level frameworks to separate the truly high-quality businesses from the dangerous financial traps. Let's get into it. To start off, we really have to address the emotional confusion that almost every single new investor goes through. You buy a stock, you eagerly wait for that big dividend payout, and then on the exact morning you're supposed to be rewarded, you check the ticker and see the stock price has dropped by the exact amount of the dividend you just got. Naturally, you're sitting there asking, wait, why did the price drop? Is the market rigged against me? So to answer that, we really need to break down the illusion versus the actual financial reality here. The illusion is that a dividend is somehow free money that just magically gets created out of thin air. But the reality, it is strictly a transfer of existing value. The money literally moves from the company's internal bank account over to your personal brokerage account. That price drop you see isn't a penalty at all. It's just the market maintaining absolute mathematical fairness. Let's actually walk through the simple math on how this plays out in the real world. Imagine you own a share of a company, and it's trading at exactly $100. Okay, now the company declares a $2 cash dividend. The very moment that $2 is earmarked to leave the company's vault, the core underlying value of that business has mathematically dropped by $2. So, the opening price of the stock automatically adjusts down to $98. Notice your total wealth is completely unchanged. Yesterday you had a $100 stock, and today you have a $98 stock plus a crisp $2 bill in cash. Okay, let's map out the timeline of when this whole adjustment goes down. First, you have the declaration date. That's just when the news drops. But the real magic, that happens on the ex-dividend date. This is the very first day the stock trades without the right to receive that upcoming dividend. If you buy the stock on this day, you don't get the cash. And that is exactly why the price instantly adjusts downward. Then we have the holder of record date, which simply logs who actually owned the stock before the cutoff. And finally, the payment date. That's when the cash actually hits your account. Now, here's where it gets a little tricky, so we have to be super careful. Not all payouts are created equal. We have to firmly differentiate between cash dividends and stock dividends. Cash dividends are a real cash outflow. They prove to you that the company generates actual money. Stock dividends, or bonus shares, entirely different beast. Look, if cash dividends are like taking a real slice of pie home with you, stock dividends are literally just taking that exact same pie and cutting it into more slices. The overall size of your pie hasn't changed one bit. And that brings us right to stock splits and stock dividends. This is exactly why they don't automatically make you richer. Dividing existing shares just creates more units floating around in circulation, but the price of each individual share drops by the exact same proportion. So while it might feel really psychologically satisfying to look at your portfolio and see 1,000 shares instead of 500, your actual total wealth remains completely unchanged. Which leads us to a pretty fascinating question, right? If paying a dividend doesn't magically make shareholders richer overnight, and it's basically just a transfer of value from one pocket to another, why do companies voluntarily part with their hard-earned cash? Well, to understand this, we need to play detective for a minute. Let's shift our perspective to the corporate side and look at the strategic, long-term reasons management actually chooses to hand over that cash. Typically, companies start initiating these payouts when they hit what we call a mature stage. They're pumping out massive cash flows, but maybe they have limited high-return projects to actually reinvest all that money into. Instead of just hoarding that cash, where honestly it earns almost nothing just sitting in a corporate bank account, they distribute it. This builds massive investor trust and acts as a huge signal that their long-term earnings are highly stable. But most importantly, it solves a major corporate governance issue. And here is the absolutely crucial point. Dividends act as a strict disciplinary mechanism against something we call agency costs. You see, there's this inherent conflict of interest between corporate managers, who naturally want to retain cash to build their corporate empires or maybe take excessive risks on vanity projects, and the shareholders, who just want a solid, reliable return on their investment. By committing to a regular dividend payout, management purposefully restricts its own free cash. They are literally forcing themselves to be highly disciplined with the capital they do keep. So how do we evaluate if a company can actually afford this discipline? We use math. Specifically, we turn to a critical metric, free cash flow to equity, or FCFE. Analysts love this metric because it is way more important than just looking at accounting profit. See, net income can be legally massaged with all sorts of accounting tricks, but FCFE, it strips away all that noise. It shows you the hard, tangible cash left over after capital expenditures and debt payments. It's the absolute purest measure of a company's true dividend-paying capacity. And that brings us to what I like to call the ultimate lie detector test for any company's dividend policy, the FCFE coverage ratio. To get this, you just divide the free cash flow to equity by the total dividends and share repurchases they're paying out. It's a brilliant formula because it strictly separates sustainable, genuine corporate generosity from really dangerous financial illusions. Now, let's talk about a massive, flashing red warning sign. If you run this calculation and your result is less than 1, you need to pay very close attention. Mathematically, a ratio below 1 guarantees that the company is currently handing out more cash to its shareholders than its core business is actually generating. In the professional investment community, we have a pretty brutal term for a ratio below 1. We call it selling blood to pay dividends. It means the company is literally burning through its historical cash reserves, or even worse, they are actively taking on new debt just to keep shareholders happy with a payout. It is a highly unsustainable strategy, and it actively destroys the company's long-term viability just to keep up appearances in the short term. All right, which leads us directly into the deadly dividend traps. Listen, you should never, ever blindly chase a high dividend yield. Why? Well, remember, yield is just the dividend divided by the share price. A massive 15% yield might literally just be the mathematical result of a rapidly plummeting stock, not a generous payout. Other traps you got to watch for: dividends funded by a one-time real estate sale, or management trying to mask terrible operating cash flows with aggressive debt-funded payouts. Seriously, when you see an unusually high dividend yield, you really have to stop and ask yourself this provocative question. Is this a genuine reward for being a loyal shareholder, or is it a flashing red siren that the broader market is severely doubting this company's future? Quite often, the market prices the stock down because the big institutional investors already know a dividend cut is completely inevitable. To actually protect yourself, you have to look beyond that simple payout ratio. True dividend safety means getting your hands dirty and diving into the cash flow from operations and carefully assessing those debt coverage ratios. You want absolute, rock-solid assurance that the company can comfortably service its debt from its actual operating earnings, while simultaneously funding that dividend check they're sending you. Okay, so how do we systematically find the actual good ones? We apply the LIEMPT standard for dividend stocks. 1. You verify stable, recurring earnings, no weird one-off windfalls. 2. You ensure they have robust, positive operating cash flow. 3. Check that debt levels are reasonable. They absolutely shouldn't be borrowing money just to pay you. 4. Look for a long, consistent history of payouts. And finally, number 5, seek out defensive business models that can actually weather a recession without instantly slashing their distributions. I love this next quote because it perfectly encapsulates the core tenet of professional value investing. A good dividend is not about the highest payout ratio. It is about a company's ability to generate real earnings, real cash flow, and share value with shareholders sustainably. Over the long haul, anything less than that is just financial engineering. So, as we wrap up this explainer today, make a promise to yourself. Never again just look at a dividend yield percentage and make a blind decision. Don't just look at the dividend number. Follow LIEMPT to understand the story behind earnings, cash flow, and capital strategy. Because honestly, that is where real investment value truly begins. Thanks for tuning into this explainer. Before you go look at your own portfolio, ask yourself one final question. Are your dividends built on a fortress of real cash or just a house of cards?